Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 2nd, 2022. It's 3:33 Eastern Time as I'm starting the video, so about a half hour to go. And what I'll do here is update some of the recently highlighted earnings trade ideas or analysis I gave you. Starting out with the Netflix, that was the first one. A couple weeks ago, they had reported. Got the snot knocked out of them, and again, it was clearly priced into the charts. Big divergent high. They took out the trend line, and I posted that one as a sell when we hit my golden shorting line back here. I had a zone from about 383 to 394 where we had multiple short ops back here highlighted on the site. Oops, I just dragged a line that I shouldn't have dragged because that's right up where we hit. Well, it was somewhere in here. Anywho, that was the boom, boom, boom. We shorted when we first broke it with that bearish rising wedge. We kicked back, hit it again with a bearish rising wedge here. Uh, Hit all these targets. It was mentioned again each time it hit, and then and again back here right after earnings. So this was an earnings smackdown. Again, the stock, and here's the common theme I want to get. I'm going to go over those that I highlighted recently as well as a couple that report tonight. But you know, this is what's going on here. Netflix is no longer one of the top holdings. It's down the list, and years ago, you know, I started calling it the FANG, FAAMG stocks, not FANG. They even published an article about that picked up on a Business Insider. Because I said at the time, Netflix, you know, it has a nice ring when you say FANG, but it was not a top market mover. So that's going to be the theme of this video. I'm going to get to Alphabet, who reported last night, but then I want to talk about the other stocks, and it continues to the theme that I'm seeing here, the developments in the market continue to play out, and that is that fewer and fewer stocks are holding the market up. Again, we're off the highs in the NASDAQ 100, don't get me wrong, but the market leaders, we'd be down a lot more if any of those market leaders broke, and they all tend to move in tight concert. You know, Facebook, Amazon, Microsoft, Alphabet, they all tend to really move closely together, highly correlated. So there's it is. Look, let's call it what it is. Netflix dropped almost 50% off the highs. I think that's safe to call that a bear market. And again, on the weekly chart, when I posted that, gave you a static chart. That was it. We hit that level. And then yesterday, I said, you know, I highly encourage take profits. Bounced 20% from that point in a week. And I saw no reason. This is major resistance. And so today, you know, if you took advantage of that bounce yesterday into the resistance level, then you sidestepped a 6.625% give back so far. So again, that's Netflix. Just updating that because that one's closed out now. I have no idea where it goes from here, but that was you know, a quick bounce trade off resistance. Well, I do have an idea. Ultimately, I think it'll most likely go lower. Um, but again, I better fish to fry. So let's not even, you know, in the near term, it's going to probably bounce back and forth and maybe trade with the market. But let's get in, update the rest of the ideas. So kudos to those of you that got in and out of that one. Alphabet last night. Okay, so in the video, I clearly stated I didn't have a strong opinion on Alphabet. If I have an opinion on where stock's going, and it's pretty strong, you'll hear that from me. And so I'll get to the other ones there in a second. But I made it clear yesterday that this one I didn't have a strong opinion on. I gave you some levels to watch, and it's popped that downtrend line. Again, this is a common theme of the markets. This is just like Apple, these big names. It popped that level, but guess what it did? And that trend line was really only a couple reactions, so really not even a trend line. I mentioned that yesterday. But here's where we're at right now is, let me take that away and show you we're right back to the previous high, and we're also at a divergent high. So number one, this has rallied into a big resistance, that previous all-time high. Trend indicator down here is we're still well below that 0.47 level, negative 0.47. And you take this line, this is simply an extension of the negative divergence. Negative divergence, you either have when your indicators are making lower lows, as they clearly are, even at this point, after this huge pop, almost 8% in a nearly $2 trillion company. That's a big gain. However, what does it do technically? Nothing. It only extends a previous divergent and runs it into resistance. And even if we happen to build on these gains, at least for a little while, anything, let's say, 15, 20%, you're going to take the divergences out. As of now, just like you had divergence back here with a major sell signal, mind you, that was a breakdown below the primary trend line, as I talked about, consolidated with its little price channel underneath, then broke down. So this is just a snapback rally at this point in time. That's all I see it as. Again, it has the potential for more. We hit major support when QQQ hit support, and it bounced like everything else. But here's the weekly chart, and there's your divergence. You can see big divergence here. And so again, it certainly has room if it wants to rally in the coming weeks here. I told you in the in the coming days I didn't have a strong opinion, but where it's going in the coming months, I still think we'll go on to take out that low and go on to hit this next target there, about 2144 and 1704. That's the GOOG, and then here's your Class A shares, GOOGL. Same chart, same company, same stock, just different share classes. That's it. All right, so let's not speak much more on that. Again, I didn't have a strong opinion going in, but the one I did, I told you there was on the daily chart, I recognized some bullish divergences, but I also looped back and showed you my call on the stock back here many months ago last year and called it down to this trend line, and that's what we hit. So this is like Netflix. Here's another stock that I'm giving you as a trade idea, especially if you're bull. I mean, if you're, and same with Netflix, if you're longer term bullish and you think I'm just talking hogwash about a big bear market this year, then hold Netflix. Ride out the pullbacks. You got a great entry last week, and let it run with stops in place to protect, maybe at break even at this point, at minimum on Netflix. But PayPal, so I'll hone in on the daily chart, but that's it. That's the target I was calling for way back here last year, and probably from that point, I forget exactly where we were. I covered it in yesterday's video. That's a 50% drop, not from the highs, but from the about from where I started outlining it. This trend line is my long-term target on the weekly. So the stock is off 60% off the highs. This again, it's not one of the largest components, but it's up there in the Nasdaq 100. It's in the top 25 like Netflix, and this is the common theme: more and more stocks in the S&P 500 and in the Nasdaq 100 are clearly in bear markets and continue to go on and make lower lows. You're seeing, I've been talking about it for a couple months now at least, breadth divergence or breadth deterioration. I'm sorry. That means fewer and fewer stocks due to their overweighting in the indexes that they have a higher, they contribute a higher percentage gain due to their weighting, the big FANG stocks, but you have fewer stocks lifting the index, so it gives the guise of a stronger market stronger than it really is, and more and more of those lower tier stocks, in the bottom quartile, even in bottom half, the bottom third, even, or your first 2/3. It's a handful. The top 7, 8. Really, the top 5 are doing most of the heavy lifting, and so this is again a common theme I'm seeing. These stocks continue to bounce, and of course, the Nasdaq 100 was up. I think it's still up today right now, but you're seeing PayPal down 25%, and that was that weekly bear flag right there. So boom, hit, done. You can either, if you shorted it, like I said, if you took it in short, then this would be a good idea to cover right around here, but I could also see possibly a move. I'm going to give you a range. It's down there. You can see I told you there was horizontal price support just below about 123.25. Two big reaction highs from 2019 and 2020, but that's it. So I think most of the downside's it. We've hit my long-term target. Yesterday in the video I mentioned this big old gap right here. If we go down, and if that bull, if we didn't break out, and like I said, even if we had broken out, I was pretty adamant that, at best I'd think it would be a quick pop and then we'd still go down here. So that's it. We hit it, and that's the risk. Here's a great example of, especially for you, those new to trading, how risk management works. When you hold an individual stock into earnings, it is always a crapshoot because you cannot mitigate that. You can only, the best you can do to fully protect yourself, or partially, there's a big cost to it, is to buy options. And when you buy options when the market's high, in other words, if you were long, if you were a bull expecting a breakout and you went long, because stops do nothing. Here's why stops do nothing. I talk about this all the time, but it bears repeating. There are two types of stop orders, essentially, the most popular, a stop limit and a stop loss. Okay, a stop loss order says, let's say you're a bull, you're going to roll the dice and say, you know what, I think we're going to break out here, and I think we're going to go up and do that target, Randy, you know, the potential pop here to that resistance, and or keep going, doesn't matter. Let's just say you were long and bullish, 197. And so, okay, so let's say you took it in advance of earnings, and that would have been from where we were yesterday. That would have been about a 15% pop, right? So a good average risk-reward ratio is 3 to 1. You know, I like to risk. Yeah, it's an ideal risk-reward ratio. You risk a dollar of loss for every $3 of profit. So on a 15% profit target, you're going to allow yourself a 5% stop loss, which is right where you can see my little pop-up box on the left. The percentage drop would be right here, and it's also, that was also good, decent price support right above that flagging area, right? Well, guess what happens? Again, two types of orders. Here's what happens to a stop loss order. Stop loss orders it's a standing order to trigger if the order will trigger if the price hits or exceeds that level. So let's say that, what is that? Whatever it is, we'll call it 165. It's a little lower than that. However, the way they work is if it's good to cancel order, which is what you would have had, it would be filled at the open because the order was triggered once you gap down below there, and then that the stop loss order converts to a market order at the open once it's been triggered. The stock opened today at 139.58, so you would have been filled on or around that level, and you would have absorbed most of that. You know, a good 20% or plus loss. So again, no way around it. Now you say, okay, well, Randy, I won't use stop losses for what you just said. I would have been filled down here. Okay, so you use a stop limit order. A stop limit order says, I'm in this stock long. I want a stop limit order at 165. And that order says, if the stock hits 165, crosses down through there, I should be sold out at 165, but nothing worse. The stop limit, you can be filled at a better price, more favorable. So maybe it kissed 165. There was a lot of movement in the market, and then by the time it filled you out at 166. So you're allowed to be filled at a better or the same price as your stop limit, but not worse. So therefore, what happens on a stop limit, it can even turn out worse than a stop loss, because the stock opened here around the top of that gap, but you can see fell all the way down. I marked the gap in purple. This is the one I referenced yesterday, and I tell you how these gaps are like magnets for traders. Well, that's where it gapped down to, because it was nearest support around. Traders kind of just flock to, you know, when things are in chaos, they're going to go to the closest support level. Opened at the top of the gap, but then your stop limit order, you're still in it. It will not fill. It's still a standing order and will be until and unless that stock gets back up to whatever I just said, 165, or you're going to just watch your losses build and build and build should this stock go lower. So basically, from where you would have been filled on a stop loss order at the open, this stock fell about another 7% from the open down to the bottom of the gap. And again, you would still have a standing open order unfilled on a stop limit order. Okay, so that's I think that's important stuff to know. You got to know your order types, and again, know that there's really no way to completely mitigate or minimize the risk when you swing trade an individual stock. That's one reason I like the indexes. You have NQ or ES. You know, I've always said this, at 3 in the morning, if NQ takes a dump and you're long and it goes on, you can have a stop loss order and it's going to hit it. There's liquidity in those futures at night, relatively speaking, enough, and then you don't have to wake up to some horrible 4 or 5% gap down in the indexes. But the indexes also aren't going to do this. They're not going to drop 25% in a day. They can't drop 25, not anymore, not since 1987 Black Monday. They implemented circuit breakers and all types of controls to slow the fall of a market in a case of a big move. So anywho, that's that. Just want to mention, there it is. And as far as zero, next up, covered in yesterday's video, StarBucks. down on earnings, but it's still in the flag. So nothing much, nothing's changed. We know now we didn't gap up. If we happen to move up, there's still big resistance about just under 101 right there. But you also have this potential bear flag, which I still favor. I still think that's going to break down. You do have some support there that comes into play at 191. But ultimately that flag should project down here to about the 82 level, and that's a level where I'd be interested if the chart's confirmed to go long. So that's my near-term outlook for SBUX. Again, they don't always have big moves after earnings. Some do, some don't. But again, a component of the NASDAQ 100. AMD, things went their way. However, it's an objective shorting up right here, right now. And this is a reason also I want to do the video. I'm covering these as both trade ideas. Some of these are actionable. Some aren't. Like yesterday, my opinion on Google wasn't that strong on Alphabet, but I gave you more firm opinions on some others of these and levels to watch. Remember, we just hit support, big support, about 99.61 on AMD last week when the markets hit support, when QQQ hit my target. And look, we just now have rallied right back. Earnings up 5% today on earnings, right back to that secondary trend line, which gave us a primary, the price channel after the primary uptrend line broke on AMD. There's the long-term uptrend line. And I'll say this, if it happens to have a little more gas left in the tank and can take out, that near-term downtrend line, you still have that line, although this one's been traded through a lot, so I'd put more higher weighting here. So here's how I would trade this. I'd short it here with a stop somewhat above, maybe above that reaction high there. Minimum, you can swing it back down for another test of this level, but we've already tapped it a few times. And if the semis are going where I think they're going, and I'm still working to get that some of those individual semi trade ideas, but here's one of them. These are my targets for AMD. I have a pretty high degree of confidence that it'll see that $74 level sometime this year, and most likely have a reaction off there, and then ultimately 59.14 looks like a good level. Big old thin zone right here to be filled. That kind of works similar to a gap. You had just a few trades through there. Vomit price histograms very thin here. You can't see them on my chart, but these are the volume price histogram bars above, and then below they're real big, and over here they're real short, and that means once that level goes, it'll probably be a pretty quick ride down to 59. And again, this is bigger picture. Near term can be a little more difficult to call, but when you get solid breakdowns on the weekly time frame, and right now, although the trend line's broken and that secondary trend line, you really need to see this breakout. This was our previous all-time high in AMD. We sat there for about a month or so. Oh, months, I'm sorry. This is a weekly chart. We sat there and tested that level, which is about 98.50 for several months, and came up, tested it again, got rejected, and then boom, there's your big green breakout candle, successful back test, off to the races. And now we back test it again. And so look, if you're a bull, you buy these back tests. If you're a bear, you wait for that to clearly give way, and then that says this whole thing was a false breakout, aka bull trap. And I would put very good odds you'll go down and hit that 72.60 target, and then ultimately this 58.91 target. And so if you short here, set your stops and just let it go. You're talking about a 52% profit on AMD. Like OCO orders, one cancels the other, so you can set your stop. You can base it on the risk-reward ratio. If you're targeting a 50% drop, you can allow yourself easily a 15% stop loss, and that's going to keep you in the game in case there's a little more upside, another thrust up. And if you want, there's nothing wrong with using a tighter stop, 7-8%. Just remember, if you short a semi, they're pretty volatile by nature. They're going to move up, down 4 or 5% in a day, a lot of these stocks. You run a 3-4% stop loss, you might as well not bother, because you're going to get stopped out in the daily volatility of those kind of stocks. So the key for me is allow wider stops. You're also on the flip side allowing the potential for much higher profit, because when these things move, the profit's bigger. And then take your position size down accordingly. So if you normally don't allow anything more than a 5% stop, but you usually trade 20,000 per position, then you can go with a $10,000 position in AMD and give a 10% stop. And at the end of the day, if you're stopped out on that trade, you're going to lose the same dollar amount you would on a normal position. So that's what I refer to as beta adjusted position sizing. and that's I write about it in the FAQ page, and how it works, how to figure it out. I even have a calculator on the site to determine your position size based on that. And then I also covered GM yesterday because they reported after the bell, or were they this morning? One of the two, either way. Doesn't matter. It's a non-event so far. It just popped back. They're trading right at that 5360 resistance level. See, they tried to break it so far and got smacked down. Intraday they tried to break it, but they're just a hair below it. So there's one you could short that right now here because you have the failure. You wouldn't want to short it earlier today because you broke above it. But I'll wait and watch, and if I see a stock attempt to break out and then fail, that's where I'll put on the short, and then I'll just set a stop just above that high right there, and that would give you a drop of about, if you're coming back down, which I think we will, to that 48.66 target, that'd be almost a 10% drop. And then if that goes, that's where I think it's lights out for GM. That's a big support level, and so I think there'd be a big drop there. But not one of my favorite, but I'm throwing it out there. I'm throwing out trade ideas. Take them if you like it. Not pass on it and wait for your type of setup, your type of stock. Okay, and that brings us up to today. After the close today, we have Facebook. Again, this one, look, today, this is something else I want to mention here. So I pointed out this downtrend line. Let me zoom in nice and tight here for you. So I gave you this downtrend line recently, right? And we took it out today. There's a breakout. That's what I call, alphabet induced, Google. Based on their earnings, it rallied the indexes up, the NASDAQ 100, and caused this breakout. That breakout could stick. It is a breakout. Take it for for what it is. However, I give it take it with a big grain of salt, because as a rule, breakouts that occur just before a big when a company reports earnings, they have a much higher rate of failing, because this thing's either gonna, they're either gonna like what the street's going to like what they report and what they say afterwards on the call, or they're not going to like it. And so this is a breakout that I would pass on, even if I was bullish on Facebook. If I didn't want to take the risk, sometimes I'll take a position ahead of earnings, usually a fractional position, wait till earnings are over and then decide whether to add to that or not. But again, I just want to point out there's a breakout, but it has an increased rate of failure. And as I've talked about, the nature of a bear market, if that's what we're in right now, it's only been a correction. I keep saying that over and over. There's still some big levels we hit. This is a huge level. This was at top of that trading range. That was a near almost a year-long trading range, multi-month trading range in Facebook, and that's a big technical level, the top of that range, and that's what we hit perfectly when, by not mere coincidence, QQQ hit my first price target. So that was a time, if you're going to buy the Qs, it's to buy the Qs is to buy Facebook, it's to buy Apple. It's all they're all, again, they're so heavily indexed that they're going to move in sync with the NASDAQ 100, give or take. And so that's what happened. So where I'll leave it is, they're going to report today. This is a big level, about we'll call it 290. Remember, there's volatility after earnings. If it pops up, it's going to keep that divergent low intact right now, and there could be more upside. I said it a couple weeks ago that Facebook was one of the more bullish looking stocks in the NASDAQ 100 to me. But one thing I want to add is, and I talk about this all the time, if we are, again, it's a big if right now, but if we are in the early stages of a new bear market, a signature of a bear market, it's like a bull market in reverse, where bullish chart patterns and setups, they either don't break out, for example, that PayPal I just showed you right at the trend line, bullish divergences, but it failed to break out on the daily, got rejected at the trend line, or they do break out, but then the breakout fails and the pattern falls well shy of the measured target, the move. In other words, a measured target, a widest part of a wedge, would say that Facebook's going to do this and take out that level there. So that's what I'll be watching for, and it'll show me the character of the market. If I see Facebook get sold down, not necessarily the night of, particularly the night of, but then in the coming days to weeks, then that's going to show me, hey, we're probably going to go down to my lower targets that I have on the index. If it builds on the gains and everything else holds up, and I'm going to start paying attention to some of the lower tiered stocks in the NASDAQ 100 and S&P 500. And if they start to stabilize or hit, very solid support, that might make the case for a bounce, a longer term bounce. All right, there's a closing bell, so we'll watch this. Again, I shared my thoughts. I wouldn't go either way. I'd just sit tight. But I also showed you an objective short on the NQs today, and then also showed you that there's about another 2% upside on the Nasdaq 100 to hit the 61.8 fib in the next price resistance level. And that's about, let's see, where we just closed on Facebook. Yeah, and look at that. That's right about there as well. About 3% upside to that it's about 338 resistance level, and then 354.80. That's also a big level too. That was a big level because we broke out right here to all-time highs, back tested twice, and then failed it right there. That was a failure, aka failed breakout, bull trap, and every time the stock has tried at that level again, it's been rejected impulsively. So keep that in mind. This is what the bulls want to see. They want to see that get taken out. If they can take that out with conviction, about 355, they'll probably run at the previous highs. All right, so those are the levels to watch. Oh, last but not least, tonight is Qualcomm. Maybe they already reported. Yeah, here's my 1 minute chart. Or gosh, some companies fire off right after the bell. So, but you're watching it trade right now in real time and spiking everywhere. Again, never react. Don't put too much into the initial reaction. But what I will do in earnings, I watch stocks, and if they gap down, like Netflix, pointed out the other day, if they gap down to key support, and they're extremely oversold at that point, I'll step in for bounce trades. This one, let's just see where the dust settles. All it's doing at this point, this is funny. This is a line I gave you yesterday. I haven't even modified it. And right now, look where we kiss it. That was my divergence line. And so I didn't extend them down here, but I had done that yesterday. And that just extends the negative divergence that was already in place at this previous high right here. So we've been diverging, and that's all that is. Now, divergence is not a sell signal. I need to say that over and over again because that's pretty important. We'll look for any type of sell signals, and if it continues higher, we'll look to see, do these divergences ultimately get taken out, and then that's nothing but bullish if that's the case. But as of now, we'll see where this one lands later tonight or into tomorrow. I'll do another update tomorrow. All right, let me wrap it up, get the video out to you guys. This has been Randy Finney with the right side of the chart. Have a great day.